Well, the International Monetary Fund today released the October 2010 Regional Economic Outlook for Sub-Saharan Africa, highlighting the broad-based economic recovery that is now underway in the region. We've got growth of 5% being projected for this year and 5.5% for next year. And Abebe Selassie, Division Chief of the Africa region at the IMF, joins us now from our studios in Nairobi with more detail. Thanks so much, Abebe, for joining us this afternoon. Well, overall, we know that sentiment has been pretty optimistic around Sub-Saharan Africa. It's managing this growth position moving forward now that becomes critical. And the suggestion has been put forward that Sub-Saharan countries consider tempering their expansionary policy now that economic recovery is underway. So quite a contrast to what we're seeing emerge in the developed world, right?
Well, I think you put it quite nicely. What we're seeing in Sub-Saharan Africa is basically a relatively quick recovery, relatively quick bounce back from the global financial crisis. And consistent with this recovery, what we're advising countries is to begin to temper policies. Policies have needed to be supportive during the slowdown, but now that the recovery is underway, I think countries will need to dial back on the stimulus that they've been providing. So that's the situation that countries are finding themselves in. I have to add that this is a very good position to be in. The reason to dial back is not so much because debt situation is particularly uncomfortable, but rather because growth has recovered, and so this calls for dialing back on the stimulus to rebuild policy buffers.
Let's take a look at countries specifically, because if we put the Ghanaian program that the IMF has underway under the spotlight here, it has particular objectives in terms of getting both fiscal deficits and debt under control. Just how much of a challenge is that for the IMF right now and for Ghana right now?
Well, I think more a challenge for the economy. We're there in a supportive role for the country. And what we see basically is, as you know, the fiscal deficit was rather large in 2008 and 2009 in Ghana, and they've started the process of reducing that deficit over time. And I think this needs to continue. I think that's something that the authorities also recognize. And this has to be balanced with continued investment in, of course, infrastructure, not just physical infrastructure, but also rebuilding health and human capital of the country. So I think the balance is, what you need is basically the right balance between adjusting the fiscal deficit while continuing to invest in the areas that are critical for long-term economic growth.
Well, it's in this context that we've just heard in the news today that investment from China has emerged as big opportunity for Sub-Saharan Africa, and we've had a $13 billion Chinese loan being approved for Ghana specifically. These, though, involve potentially debts that need to be repaid. So how does a country like Ghana balance the investment that China is making with making sure that that investment debt is productive and that the investment will generate economic return to repay that debt moving forward?
Okay, I think you've touched on all of the key parameters there. Number one, I think the important thing is to only borrow the amounts of resources that you can effectively use at the time at the moment. So it's no good borrowing a large sum of money if it's not going to be used immediately. You'll just be accruing interest. So I think the key is identifying high rates of return projects and borrowing consistent with those returns of projects. Traditionally, the difficulty in the region has been also recovering the rates of returns from these projects through the tax system and the like. So, you're going to have to rebuild to build up your resource mobilization capacity, particularly in the tax system, so that you're able to capture the high returns and be able to repay the debt positions. I think the key, really, from the macroeconomic perspective that we look at is to ensure that the deficit levels, the fiscal deficit levels that governments are targeting are consistent with medium-term considerations. These considerations are twofold, I would say. One is, of course, promoting growth. And the second is also, it's no good having a lot of investment to promote growth if you're building up a debt burden. So I think you need to strike the right balance between investing for future growth, but also ensuring that you don't end up with undesirably high debt levels.
Where we've got productive economies in the spotlight, what impact do you see the currency wars conversation that's currently underway having on Africa's overall growth and output?
I think the outlook for the region is fairly good. Looking ahead, we're projecting growth of 5% this year and 5.5% in 2011, so growth accelerating. And in the low-income countries in the region in particular, you're going to see an even bigger pickup in growth between this year and next year. At least that's our projections. And providing this prevails, what you're going to see basically is a return back to the high growth years of 2004-08 or so. Now, this presents a lot of opportunities, of course, for companies, for businesses from outside, and we're seeing a lot of money coming into the region. Not just FDI type of flows, but also portfolio type flows. And managing this plenty is going to be as big a challenge as it was managing the dearth of capital in the past. So we see the challenge really going forward being recalibrating policies to move away from focusing on short-term objectives to more medium-term objectives.
So on this currency front in particular, Abebe, I mean, should Africa be intervening? And if so, what policies would be appropriate in response to the kind of currency strength we've seen emerge on most fronts when it comes to Sub-Saharan Africa's major countries?
Well, I think it's very difficult to give one policy for all countries. I think it depends on the context, and among the things countries are going to have to look at is the exchange rate already appreciated? If it is so, then you have to consider ways of trying to lean against it. But there may be countries where the exchange rate is not overly appreciated and there's room for appreciation in the face of inflows. So I would say it depends on country-specific circumstances. There are some places, South Africa is a good example, where there's been a lot of foreign capital inflows, and the currency is probably at the top end of the valuation range. So those kind of countries will have to take different policies from other countries where the exchange rate has been weak and there's more scope for it to appreciate.
Well, of course, this is not the